What's going on, everyone? It's your boy Nathan, the coach, here with Win with Nathan, guys. I guess I gotta come to a rescue again. And so on this video, I'm gonna debunk a debunking video. I know that sounds weird, but I know recent videos, I think I put them out there. I was doing coach approved, is this right? All that stuff, showing you video clips. This time I'm not gonna do it. The reason I don't wanna do it is I don't wanna offend this person. I don't wanna offend this Facebook group, YouTube thing. I don't want to offend them because they're a big name in the space, especially around short-term rentals and lending and real estate. I don't want to offend them, but I want to debunk a lot of things that their video said. The reason I'm doing this is basically, it's kind of funny. I had a client send me the video. They said, hey, is this true? Because it's the exact opposite of what you just told me over the weekend, Nathan. So when someone watches something and that person says, what I say doesn't exist, I dive into things. And the funny thing is too, yesterday and last week, I talked to two different clients who actually used this person for their loan and talked about how bad of a time they had and how big of a struggle it was. So after 3 strikes, let's dive into it. So guys, my name's Nathan. I'm known as the coach. As you can see, I get called DSCR GOAT by a lot of people. I'm not LeBron James. I don't claim it, but because people call me that, I had someone do some art, right? So it's cool. So guys, the reason I think people call me the GOAT, it's not because, or that I'm really good at, especially DSCR loans, is because I don't just focus on volume, right? Like you could do 200 million a year, doesn't mean you're good, right? And this video actually talks about that. So let's dive into this. So number one, before this video, you should listen to this video, we have to clear up a misconception, right? A misconception is, what is a conventional loan? If you look at the definition of conventional that's set forth by the CFPB, which all lenders are supposed to be following the CFPB, right? Conventional loan is any loan that is done on a residential house that is not backed by a government agency or entity or government loan, right? So that means that conventional is Fannie, Freddie, full doc, alt doc, bank statements, asset depletion, and DSCR. That is the true definition of a conventional loan. So where these lenders and these experts all intertwine things as conventional is only Fannie and Freddie, they technically get it wrong. So there's debunking number one. And the reason I say that is because this guy, before the video starts, he clearly states conventional is better than DSCR in most situations, unless you have untraditional income, or you've hit your maximum amount for conventional loans. So first off, completely inaccurate, right? Because conventional is DSCR. Secondly, anytime someone claims to be an expert and they make a boldface, broad statement like that, I think they're shooting themselves in the foot. And here's the reason. Any good originator, whether broker, retail, or a banker, or a financial coach, is going to have a conversation with you. Depending on your goals will determine which route is better for you. So to say most situations go conventional, which I believe he's saying Fannie and Freddie, even though the terminology he has is wrong, it's not, right? Now, I've done debates with people who are primarily agency-focused lenders, and when you have a debate, an honest, transparent debate, there's a lot of benefits that DSCR brings that Fannie and Freddie can't, right? So you have to have the conversation. Not every lender can do all the benefits, right? So for example, DSCR, do you want to close in an LLC? That's the first question anyone tells me they're buying an investment property. If that's the case, I'd say, hey, look, we can't do agency loans. We can't do Fannie and Freddie. We can do all other conventional loans. We can do full doc, alt doc, bank statements, DSCR. Then I ask the next question. Then I ask the next question. And I always find out what loan is best for their goals and their strategy. So to say Fannie and Freddie or conventional is usually better unless these two reasons, that's wrong. And this is the reason why a lot of people are getting the wrong products, because people are always saying, let's go agency. And the number one reason for that, I believe, is because they make more money off agency. Most lenders make more off agency than they do any other loan. That's the truth. So, and the second reason, they really just don't understand strategy, right? They are a rate chaser to win your business. They're not a strategist. Is that the right word? Yes. They don't understand everything. So DSCR is not just a fallback loan, guys. It's a great strategy play, right? The next thing they do talk about recourse versus non-recourse is a huge debunk in DSCR. I think that's a great example of how they did it. I think they did a great job on it, but here's where I do think they fell short. Not everyone on the LLC has to sign a personal guarantee, right? So some lenders will tell you anyone who owns over 20% of the LLC has to be on the PG, personal guarantor. It's not true, right? Every lender is different with this. So depending on your strategy with your LLC, if you have a syndication, anything like that, you want to make sure that the personal guarantor is set up correctly, right? Not everyone who owns a piece of the pie has to be on the personal guarantor. We allow one person, right? There are guidelines around it, but we could have 1 out of 6 people on the personal guarantor. The other 5 people don't have to sign the personal guarantor. So they did do a great job on recourse versus non-recourse. The fact is that a lot of people think DSCR loans are non-recourse. I believe it's because they follow big groups like Bigger Pockets and so on, and just get a lot of misinformation out there. So that's a huge thing. So third thing that I know they tried to debunk, but I think they messed up on, is they talked about the titling, right? Title and the loan are 2 different things, yes. But he made the statement that you can't close conventional loans in title. That's actually false, right? Because if you listen to what a conventional loan is, you don't have, the only option is not just DSCR, right? You can do a full doc loan, a non-qualified conventional loan. Full doc is treated almost just like Fannie Mae, but has some extended guidelines, and we can put the title in the LLC. So do we have people that go that way? Yes. I just closed one last month that way. I told the guy, I said, look, I don't understand why you did this. DSCR would have been an easier route. Why'd you go this route? And he's like, well, it was 0.25% less in interest. But he had a harder time qualifying because it was debt to income. He had child support. He had divorce. He had all that stuff. So in that situation, we closed a conventional loan in an LLC. We didn't close a Fannie and Freddie. We closed a full doc conventional loan by the definition of conventional. So guys, there's more loans out there than just what they say, conventional, Fannie, Freddie, and DSCR, right? There's bank statement, alt doc, all that. Now, another benefit going full doc, alt doc, versus DSCR with rentals is, of course, looking at the prepayment penalty. The prepayment penalty is usually less on other things that aren't DSCR. There's still a prepayment penalty usually, but it's usually a less percentage. So can you close a conventional loan in an LLC? Absolutely. Can you close an agency loan, which is a qualified mortgage? No. I've not seen that. Is it possible? Maybe. Right? If you go to the local bank here, they'll tell you they do conventional loans and they close in LLCs, but it's not being sold to Fannie and Freddie. It's a portfolio loan. It's their own loan, but by definition, it is a conventional loan. And you can close in title. So right there, that's wrong. Now, the other thing they talked about, and this is dangerous, I advise you talk to a title company and your attorney. But they talk about, take title in your personal name and quit claim to your LLC. Not a big fan of that at all for several reasons. Last week alone, I took this big nugget out of a mastermind. A guy's dealing with a lawsuit, some legal aspects, and found out the hard way that just because you quit claim, it's actually more harm than good. And he's not protected by I think he said his title insurance. He said he learned that when you quit claim, you do lose things. There's a different way to do it, but seek your attorney out to make sure you do it the correct way. But he said, absolutely do not quit claim. And if you do quit claim, make sure you ensure everything else is staying the same. It all depends on what your strategy is. So there again, I probably wouldn't do it. I also wouldn't recommend someone taking title in your personal name, knowing that you want to go to an LLC, because here's the thing, guys. I'll always be able to find your personal name. It's always going to show up probably on what's called a fraud guard report. If you try to get another primary home, because your name's going to show on a property, it will show that it's quit claim. And I know a lot of lenders out there are going to say, oh, just say it's not yours anymore. I mean, you're putting on a legal document that's going to Fannie, Freddie, or any lender that's saying, oh, that loan's not mine, it's my business. Well, then there's guidelines of how to write that off, right? So I would be very careful with that strategy. So fourth and biggest issue I have with this video is he basically said 15% down with STR income doesn't exist. That is the biggest bold-face as of today, April 1st. This is not an April Fool's joke either, guys. 15% down with STR income does exist. I close them. I'm doing one right now. And this is the reason why I'm doing this video, because the lady called and said, hey, you just qualified me on 15% down. You said we're good, everything. This video is telling me that you can't close it. Here's the thing. He even says that this video, they claim they're the best. They claim that they have over 200 lenders they shop to, and they say that they know all the guidelines, and one lender will do 15%, one will do STR, but you can't find them both. Well, a couple things. One, they need 201 lenders because apparently they don't have the right lenders. Or two, they just don't understand the guidelines. So as long as I've been doing these with this company, we've always had 15% down option. We had 20% down STR, but for the last 5 months, we've opened the door up quite a bit. As a company, we've been expanding our guidelines, extending them while others have been contracting. So does 15% down with STR income exist? Yes. He makes a comment that you can't close those. What he means by that, I think, is that he can't close those, right? Just because it's out there and you can't close them doesn't mean it doesn't exist. Because here's the other trick. There is a 10% down DSCR loan. Right? I did a video on this, was it 3 weeks ago? And I was wrong. I didn't think it existed. It did exist. 10% down does exist. Does anyone take it? Very rarely. You have to speak with a loan officer, originator, an investor who understands the strategy behind it, gets it, because it is truly a purchase with a DSCR type loan with 10% down. It's not for everyone. It's a higher rate, higher cost, but it is out there. 15% down, if you can't get 15% down to work with STR, income, that means the property is not debt servicing. That's not a guideline issue. That's an issue along how you ordered the appraisal, or it's along the lines of the property's not solid. You have 4 ways to underwrite short-term rental income. And if you're telling me all 4 ways don't debt service at 15% down, probably means it's not a good property at that down payment. So then you put 20% down or you buy the rate down. It's the same exact thing as 20% down, guys. There is no difference in underwriting 15% down and 20% down with STR income. Again, I'm talking about guidelines that I know inside and out. I'm not talking about, I don't sell to 200 people because 200 people change all the time, right? I don't do that. I'm talking about the guidelines directly from the investors. So it is out there. Don't listen to them. It's out there. I'm doing one right now, but I am also going to say this. A lot of people will not choose that option. It is only chosen select times because they're working with someone who understands strategy like myself. I don't believe in 15% down is always the best option. Now, if you're going to refinance because you're doing forced appreciation and you're going to basically in a year have it remodeled and all that stuff, I think it's a good option. But most people will choose 25% down, not because that's what it takes to qualify. It's because of the strategy and the exit plan behind it. I'll also talk people into doing 20% down. I tell people all the time, like, if you work with me, I'm going to give you some options. And he talks about like they can shop 200 people. Okay. So out of those 200 people, how many give you 9% seller concessions, right? Or up to 6%? Most people who want to do 15% down, it's because they really only have 21% total to put down. They have a down payment, 15, and then on average, they're going to have 5 to 6% in closing costs, depending on the loan size, right? So when you put those two together, you have what's called cash to close, which is around 21%. Well, when you work with someone like myself or people that I train, you're going to realize the strategy here is why not put 20% down, get the better rate, easier debt service, higher debt service ratio to maybe give you an extra discount, and then get the seller to pay up to 6% seller concession or up to 9% if it's a new construction. So my cash to close on a lot of those deals is still 20%, right? Now, they could do 15% and get 6% seller concession, do the same thing, but most people who ask for 15% down plan for 15% down plus another 4 to 6% in closing costs. So they're planning on 21% roughly out of their pocket. Right? So why not do 20% out of pocket for the down payment and all the fees are paid for the seller? The number one reason I see why people don't do that is because their agent is not good at negotiating. Their agents don't understand seller concessions, right? Guys, seller concessions is the biggest thing. So 15% down short-term rental income DSCR loans do get underwritten, they do get approved, they do close, and they do work. The fact that he says they don't and that it's a lie just cracks me up. So they do a lot of loans, and they probably do a lot of loans because they are big with marketing, right? They're on some of the biggest channels. Doesn't mean they're the best. The other thing that I have he brings up something that they have a lot of pull in changing guidelines. I mean, come on, guys. What broker really has that much pull? At the end of the day, they talked about doing midterms. Guys, midterms have always been around. You can always underwrite to midterms. You can't use projected income for midterm, but a good lender, a good originator will be able to take comps from the seller agent and say, hey, that's a midterm. That's a midterm. That's a midterm. Those are 3 midterms. Get the last lease, put it on the appraisal on the 1007, and use that as rental income. Nowhere on the 1007 does it say it has to be a lease for a year to year, right? Appraisers have the ability with market rent under non-QM to put what the income is, right? So if they say, hey, the last lease was for 3 months at 50 or 2,000, this lease was for 6 months at 2,500, and then this one 3,000, an appraiser can determine on average what the monthly income will be. There's no guideline that says you can't do that, right? At least I haven't seen, right? So midterm has technically always been around. What people are working on behind the closed doors is trying to find a way to project it, right? It is tougher. There is appetite out there for things like pad splitting, room share, but there's not much appetite. And the reason I bring this up is because if you find one person that's willing to do it, they're going to have like one investor that's willing to buy those loans. Either you're going to have a huge loan level pricing adjustment. You're going to sacrifice guidelines usually somewhere else. Like instead of doing 15% down, you might be 30% down, right? There's going to be some trade-offs. So when there's very little appetite out there to buy those loans, it's a risk. Here's the other risk, right? You might have a broker or a loan officer say, yeah, we could do that loan, but there's only one appetite out there. As soon as it dries up or they get like any issue and they say, hey, we're not buying that anymore, you're out of luck. They can't sell that loan to someone else. This just happened 2 months ago. I think it was 2 months ago where a lender came out and said they had 5.875% interest on a DSCR loan. Now you had to do 50% down, all that, but they said it was someone on Wall Street was willing to play ball, had a discount. Awesome. They said it will only last until they change their mind. It lasted all of a week. So even if you did the application and you haven't closed within that week, they weren't funding that rate anymore, right? So you have to be careful when there's little appetite. Yes, it's exciting that there's new guidelines, right? We've been working on something where we take leases, right? Where we'll look at taking a lease on a purchase, which most lenders do not do. I know that because I've done the research for a lot of lenders. Will I look at 200? Absolutely not, because there's not 200 good lenders out there, right? I usually look at the best and look at the options. But from what I can tell, no one out there is taking a purchase long-term rental with a lease. We've been working on that. We have a way to do it right now, but it's in progress. Investors are smart when they look at guidelines. They look at, what's the appetite out there? What's the risk, right? So is there an investor out there willing to buy room? Yes. But do most of the lenders want to go with that person right now? No, right? Because there's strict guidelines around it, right? So it's a trade-off where a lot of people talk about and just say it's as simple as we have pull and we're changing things up. It doesn't change like that, right? It changes because the investors see a need across multiple channels. Just because one broker has a need for it doesn't defend the reason why you should change all your guidelines or pricing just for one thing. So every quarter we are updating our guidelines. Every quarter we've been adding guidelines, right? We're looking to update again come this next quarter, right? And we're excited for some of the changes. But guys, at the end of the day, you can't always do midterm, right? We've done them. So technically on the appraisal, you could do midterm, and we've seen it and we've closed those. As far as pad splitting goes, he was dead on, right? There's a master lease for refis. It's a beautiful thing. I think it's great. Now, I do know one lender out there right now that is doing pad splitting. However, they have a very strict guideline around down payment and pricing. It's a different ball game because they only have one outlet for it, right? People go there for it. It's a great thing. So, guys, debunking a debunking video, you don't just go one place, right? Don't just go to one broker and ask, because here's what I see. I have multiple roles. I'm seeing right now the good brokers out there, and there's some phenomenal brokers out there, they don't use 200 lenders. They don't look at 200 lenders. They usually have 3. All right, they have 3 lenders that they do certain loans through. They trust, they get it done, and they have relationships with. Right, those brokers are great. What I'm seeing a lot of brokers do, and these brokers are not, I don't know what the word is, but what they're doing is they're typing a long email and giving scenarios, and they're emailing it to every lender that's on their list and saying, hey, does this work? Does this work? Is this a DSCR? Is this blah, 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 blah? What's the debt service ratio on this? What's the income I can use? All that stuff. Guys, if your broker has to email a scenario out like that to a bunch of lenders, you're paying a broker to be a secretary, right? I don't even respond to those emails anymore. Because here's the thing, like if a broker says, hey, what's the rate for a DSCR? How are you quoting your customer? I could tell you 5%. I could tell you 10. I don't know, because you're the broker, and there are several factors that go into pricing. It's just like every other loan. They have the access to pull credit. They have access to pull rates. They have access to pull the guidelines. But I'm seeing a lot of brokers get lazy today, and actually loan originators too, where they email to try and ask someone else to do their job. So if you have 200 lenders and you're trusting that person to find the right solution for you, more than likely they're sending a blast email out to everyone. I don't think that's what's best for the customer, but whatever. They talked about how they could steer a customer, fine, steer a customer. So guys, don't trust a broker just because they do a lot of deals. Trust a broker who is knowledgeable. Trust a loan officer that does the loans, who knows the guidelines, who knows how to get an answer, right? If you look at the top people out there in the country that are originators, a lot of them are with retail. The reason for it is because they want the support. They want access to underwriting. They want access to the full guidelines, all that stuff. I love brokers. There's a lot of good brokers out there, and they don't do the crap I'm seeing right now. But the ones that do send these blind emails out, dude, I looked at one guy last week. He sent 5 scenarios. He had 5 opportunities for loans. Sent them to 18 of us, 18 different lenders. And he asked all these questions, right? Not enough information to go off of. All the answers he wanted are easily found on the matrix. I didn't respond to his email because obviously it's not worth my time, right? If he's going to shop 18 people to get an answer, it's going to be a headache of a loan. And so at the end of the day, I didn't respond. Hopefully he found an answer. I really don't care. I lost a loan this weekend. I told the lady I didn't want her loan because she kept telling me how much this other guy was saying he's bigger than our company. He's better than us. Funny, we have 1,000 Google reviews. He has 16 Google reviews in 13 years. How could you be better than someone who's got a lot more reviews in a shorter time? And then also, here's the thing I proposed to her. You're asking for advice from a guy who is not licensed in your state. So I'm licensed in the state you need a loan for. I can tell you about every type of loan and give you the benefits of each and compare rates. This so-called better mortgage company is only licensed in California. So the fact that they can only do DSCR in a state means they're always going to tell you DSCR is your best option. But what she failed to realize is that, like, she was asking about agency loans, asset depletion, all those, and we're giving her the scenarios. The reason I told her I didn't want her loan is because she was a handful. She kept calling me to tell me that this broker was bad mouthing us and how bad we were. And I'm just like, look, I don't care. My pricing you already said is better. I can already guarantee you I can get the loan done. The fact that you're listening to this guy badmouth us to try and win your business, I don't want your loan, right? I know what I can do, and I left it with this. Until that broker can tell me they've closed a clear to close in 4 days from submission, order appraisal, title, everything in 4 days, I don't want to hear from that person or hear that name ever again because they are nobody to me, right? I've done it start 4 days. Can't say anyone else has on a DSCR loan. So guys, that's me debunking a debunking video. I know this video is long, but guys, don't just take one video, do your due diligence, right? Take my video and go ask people, right? Go look at online. You can go online and see a lot of this information. You don't need a broker or a loan officer to really show you a lot of it. You can easily find it online. So guys, remember this. DSCR, 15% down, short-term rental income does exist, 100% exists. We close them, we do them. It's a bold-faced lie if someone says it doesn't exist. That is as of today, April Fool's. It's It's not an April Fool's joke. It's actually out there. Could guidelines change next quarter? Absolutely. Could they change 2 weeks from now because of the investors and what they're buying? Absolutely. But as of today, that guideline's been around for a while. We've been closing them. If you have any questions, give me a call. Till next time, it's your boy Nathan, the coach, here with Win with Nathan.